Hey, my name is Tucker Krause, and welcome back to my channel. In today's video, I got another news update for you guys, so let's not waste any time and get right into it. I'm also going to be covering jobs numbers this week. Alright, jobs openings plummet. June JOLTS reported 10.698 million, expected 11 million, so a 0.3 million miss. Job openings, and plunging by 605k compared to May, the third largest drop in history. And so, of course, job openings dropping, that's not a good sign. We can see, when else were they dropping? Oh, March 2020. Oh, 2008. Right, and we can also hear the monthly change literally only beat out by, I believe this would be March and April of 2020. Worse than anything we ever saw in the Great Recession, though in all fairness, the job openings are also significantly higher than they were pre-Great Recession. But overall, this is not the best sign, but there is more to it. So we have from Carlo Cassio here, June jobs openings are showing effect of hike cycle. Bear in mind that a super hot labor market leads to a lot of job postings gaining. June is down slightly to 10.69 million versus 11 million expected. May was revised higher though. This is still an opening unemployed balance of 1.81, way off a balanced 1. And so essentially what he's saying here is, yeah, the job market is still hot because we still have a historically high number of jobs openings. And so especially when you compare it, there are 1.81 openings per unemployed person. That shows that if people started coming and actually taking these jobs, right, because we have a lot of these great resignation people, the labor market is still actually doing not too bad when we look at this metric here. Though, when we look at the payrolls, it's kind of the opposite story. But before we look at that, consumer credit rebounds, second largest spike on record, 40.154 billion added compared to 27 billion expected. So last month when we covered this, it looked like, hey, maybe consumer credit was finally being tapped out, and as this came to the downside, that was going to lower consumer spending even more, and of course, just, be not good. Though, of course, it looks like we've got one last hurrah here, potentially. Maybe it's going to keep going higher, or maybe this is just, like I just said, one last hurrah before it comes crashing down. Who knows? I can't really predict that. Again, we'll have to keep watching this to see as it starts to tick down, because that shows that, of course, if consumer credit falling, when everyone has super high credit right now, of course, that probably means consumer spending is falling as well. Alright, and so as consumer credit keeps rising and savings keep falling, the recession will only be made worse, as we can see right here. This chart doesn't go back very far, but in general, the credit is at near an all-time high, and savings are at an all-time low. So of course, that's not good for when the recession does truly come. Because right now, I don't know if we're necessarily in a recession yet. Yeah, there's a technical recession, but GDP is also a not very good number if you know a thing or two about basic, correct, aka Austrian economics. But of course, that is beside the point. Let's keep moving. Alright, seemingly strong jobs numbers. US July non-farm payrolls, 528k, expected was 250k, and June was 398k. May and June were also revised upwards for 28k total increase. So on the surface, this seems great. But let's quickly cover the wage inflation here. The US July average hourly earnings month over month was 0.5%, expected was 0.3%, and June was 0.4%. And for yearly statistics, 5.2, expected was 4.9, and June was 5.2. And so, of course, upsides here for wage inflation. Of course, that probably goes with what we saw earlier with that ratio of unemployed to jobs openings, right? That's showing that employers are having to push up their wages to actually encourage people to come and work, which of course puts even more pressure on consumer prices, right? We were kind of seeing last month, a lot of people were saying, maybe we're going to see consumer prices top out because we've seen a lot of commodities pull back. But at the same time, when we look at numbers like this, that might not be the case. Again, we'll just have to keep watching it. I definitely can't predict that. And Peter Schiff dives into the jobs numbers a lot more here. I'll just read through it here. The gain of 528k jobs in July as the labor force participation rate fell to 62.1 means that most new jobs went to people who already had the jobs. Collapsing real wages forces many workers to moonlight to pay the bills. If the labor market were strong, one job would be enough. And so, again, that participation rate goes into what we've been talking about this whole video. So this is showing that overall people are having to take on more jobs, which is, of course, not a good thing. It's not a strong labor market if you have to take on multiple jobs just to survive, or a strong economy in general. And so, of course, this shows that those people who are actually taking the jobs, when we compare to that job openings unemployment ratio and all that, is that people actually taking the jobs are people who already have jobs and are struggling to make ends meet. The people who already aren't working are not coming into the labor force. It's the people who are already working are adding more to the labor force themselves, which is not what you want at all. And to continue on this, there was a net loss of full-time jobs in July. All of the net 528k jobs were part-time jobs, most of them low-paying service sector jobs. Since the number of people in the workforce keeps falling, these part-time jobs went to people who already at least have one other job. So that continues the point. The job market is not all that strong right now, though in general, it's still not quite at, like, horrible recession numbers yet. That's why I was said earlier, we're probably not quite in a recession yet, though I imagine we're very close or on the verge of one, or it just started. Though, and if anything, it could actually be worse than this, what we're seeing with the jobs. We can see here that the household surveys have actually been flat and ticking down a little bit, whereas the establishment surveys have been continuing to grow. And so, of course, when we just add everything together here, sorry, the audio cut out. Basically, all I have left to say, though, is overall, it's definitely interesting, these jobs numbers here. Overall, it does look like they are starting to weaken, but when we look at some things like job openings, we can see that it hasn't quite collapsed yet, so we'll just have to keep watching. Seems like there's some weakening. Anyways, that's all I've got. Do your own research. This is not financial advice. Thanks for watching, and I will see you next time.